Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Admitting Partners and Valuing Equity for Internal Transfers of Ownership. Before we begin, we need to cover a few important items. First, please close any other programs that you have running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you participate in all 3 of the polling questions throughout the presentation, and please note that GoToWebinar does monitor your participation in the polls. Next, you must complete the online evaluation. It will appear immediately after the session is in your browser, so please take a moment to complete that before you close the browser. Once both of those requirements are met, the certificate will be emailed to you within 10 business days. In order to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top that will minimize the control panel. During the presentation, all participants are muted, but you can communicate with us using the question box toward the bottom of the panel. Just type your question in the box and click Send. Time permitting, our presenter, Terry, will answer all of your questions today. And finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. Our upcoming topics and dates are listed there. Topics include roadblocks to avoid, the how, why, when, and with whom of mergers, and keys to retaining clients and staff through a merger. You can view a complete list of our webinars, including links to register for them, on the CPE courses section of transitionadvisors.com. And just a reminder that you should have received a link in the reminder email that went out earlier today for you to download a copy of the slides in advance. I've also just sent that link to you via the chat function, so if you'd like to download the PDF and follow along, you certainly can. You'll also receive a link to that in the follow-up email, or you can just email me, and I'm happy to send it to you as an attachment as well. Now I'd like to introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thank you, and enjoy the webinar.
Thanks, Nikki. Before we get started here, I just wanted to sort of give you a little background on our firm in case you're not familiar with us. We are a national consulting firm that focuses 100% on accounting firms and only on issues related to ownership transition in accounting firms. The services we offer include working on mergers and acquisitions. We do searches on behalf of firms seeking a merger or acquisition or sale. We, the services around that include, of course, introducing the parties and then complete support of the entire transaction from start to finish. We also support firms who have found their own potential merger partner and oftentimes help fill in the gaps that they have internally in their expertise and experience with that type of transaction. And then finally, we're heavily involved with other issues related to ownership transition internally. For instance, helping to restructure owner agreements, developing succession plans for firms that have a need for that. So anything having to do with the ownership issues related to an accounting firm we're involved with. I'd also like to point out that there's a tremendous amount of information on our website about including articles that we've written for the Journal of Accountancy and other trade organizations in the accounting profession, and also recordings of many of the webinars that we have done over the last couple of years. This webinar will be recorded and loaded onto our website, and Nikki will give you more information about that at the end of the presentation. I wish I could sit across from each of you and just answer all the questions that you might have specific to your situation. I enjoy doing that, and if you have anything that comes up during this presentation that you'd like to ask a question, I'd be happy to answer it if we have time. If we don't have time, we will send out an email to everyone with the question and the answer to anything we didn't answer. And finally, if you want to follow up with me by email or even calling me, I'd be happy to talk to you about your specific situation. Oftentimes people think of things as we go through these webinars they'd like to know more about. On today's agenda, we're going to talk about first how you value equity in your firm, what the basic terms are for buying out partners in an accounting firm, the concept of a backwards valuation, which is a technique that we use to assess the viability of the terms and the valuation for an accounting firm ownership, other buyout terms that need to be considered when buying out partners, and then the owner agreement. And then finally, the techniques for admitting new partners, which we'll get into in depth at the end of the presentation. That leads us to our first polling question. Nikki, I'm going to turn it back over to you so we can get a feeling for where everybody stands with respect to their own owner agreement.
Okay, thanks, Terry. Our first polling question is, does your firm have an owner agreement? So the options there are yes, and it's signed by all owners. Yes, but not all owners have signed it. No, but we need one. No, and we aren't sure we need one. So take just a few moments here to answer the poll. Just a quick reminder that you do need to answer all three of the polls today in order to get your CPE credit. Okay, looks like nearly everyone's completed it. We'll go ahead and close the poll. The results indicate that 40% say no and we aren't sure we need one, 32% yes and it's signed by all owners, 19% no but we do need one, and the remaining 9% yes but not all owners have signed it.
Okay. Those are kind of typical responses that we get. It's surprising to me how often we end up with situations with agreements where sometimes agreements have been drafted and no one's ever signed them. Oftentimes they're drafted and new owners haven't signed them, and I think it's just an indication that, needless to say, not everybody's comfortable with the current agreement and it probably needs to be readdressed, which is something we do regularly. When you think about the value of an accounting firm, you really need to think of it in terms of two pools of value. One is the tangible assets, which include basically are represented by your accrual basis balance sheet. So that would be the big asset that typically is on there that needs to be addressed is receivables and work in process. Your furniture and fixtures oftentimes don't have a lot of value, and anymore because of the tax laws, most firms don't have a lot of book value for their furniture and fixtures anyway. If you have liabilities other than retirement liabilities, but if you have liabilities for bank debt or other types of debt like that, that obviously enters into the net equity as well. So when you think of the tangible value, look at the partner equity section or the shareholder equity section of your accrual basis balance sheet, and that's primarily what we're thinking about. The preponderance of your value is going to be based in the intangible pool of equity, and that would primarily be associated with your client list. And of course, it involves all of the intangible assets in your firm. So your workforce in place, the brand equity, restrictive covenants, anything else that you have that's an intangible asset is what we're talking about in those terms. But as I said, most firms think of their intangible value as being primarily associated with their client list and their client relationships. So when we think about the overall value of the firm, when we say your firm's worth 1x or your firm is worth 3 times compensation for intangible value, and we're going to get into those issues in just a second here, consider that may not be all the value, that we're probably also on top of that oftentimes is the tangible equity as well. When we think about valuing the intangible equity in your firm, there's generally 3 primary ways that most firms do that. One is looking at the individual books of business that partners manage, and this is probably a technique that's used by mostly smaller firms. Oftentimes firms come together with 3 partners come together, they all have existing books of business that they might have developed somewhere else, and they look at their value and say, well, my book's $800,000 and your book is $600,000 and your book is $400,000, and those represent the relative equity or value that each of us brings to the table, and so they go forward with valuing the firm on that basis. As firms tend to mature and become larger, they tend to go into the next type of intangible valuation technique, and that's an equity multiple. And generally what we're talking about there is we look at the overall, generally the overall revenues of the firm. If the firm has $2 million in revenues, then we assess a multiple on that. Oftentimes we're using 1 times. We might be using 0.8, something like that. We say the overall firm's intangible value then is $2 million. And if I have a 20% ownership stake in that firm, then 20% of that $2 million is what my ownership stake is worth for the intangible value. And then finally, generally, as firms become larger, they tend to migrate more towards a compensation multiple. So we look at the compensation that a partner has. Many times it's going to be an average over several years, and that times a multiple becomes that partner's intangible portion of the overall firm's allocation of intangible value. There are hybrid methods that we'll get into that use a combination of these techniques, or that maybe sometimes are even just an agreed upon value, but generally most firms are using one of those 3 techniques. The PCPS has done a survey now, did one in 2008 and also in 2012, succession survey, which if you're a member of the PCPS, I highly recommend you obtain a copy of. There's a survey for sole proprietors, and then there's a separate survey for multi-partner firms. In that survey, we found that about 37% of the firms that responded to the survey use a multiple of equity method. 16% use the book of business method, 22% the multiple of compensation, and 25% use something else. Of the ones that use the multiple of equity or the book of business method, less than 10%, actually about 8%, used 100%, something more than 100% of revenues as the valuation multiple. And I can tell you the trend over the last 10 years has clearly been for valuations on internal transfers to come down. There's a lot of reasons for that. The primary reason, of course, is that there's a demographic bubble of baby boomers within the accounting profession that are all going to retire, close to each other. The AICPA estimates that roughly 70% of the owners of accounting firms in the United States now are age 55 and older. So we have a lot of people that are going to be retiring at the same time, and firms feeling that pressure are pushing their valuation multiples down in order to take some of the financial pressure off of that issue. About 42% use 100% of revenues. That tends to be still the most popular multiple, although it's less than half the firms that are using it nowadays. About 30% between 75 and 100, and actually less than, or about 20% are actually using less than 75% now. The larger the firm, the smaller the multiple tends to be. So some of the larger firms that use still a multiple of revenues in their valuations are using as little as 50 to 65% of revenues now as their multiple. Mark Rosenberg does an annual survey as well. I highly recommend it, that you obtain it as well. And in his survey, they found that firms that are less than $2 million in revenues, on average, use about 88% of revenues as the revenue multiple. Now, this is a combined effective rate, so some of these firms are using a multiple of compensation. But in looking at the overall value compared to revenues, that's what you come up with. Excuse me. In the range of $2 million to $10 million, about close to 80% is the multiple and average multiple, and then that pretty much holds for firms between the 10 and 20. So really, you see about 80 to 90% is the average of the firms that respond to the Rosenberg survey. For those firms that are using a compensation multiple, again from the 2012 PCPS succession survey, about 40% use 3 times, and then you can see that 15%, about 2.5, and between 15 and 20 use 2 times. You know, the traditional way of looking at the compensation multiple for firms was that 3 times compensation was supposed to be the same as 1x, and that's because traditionally firms would generate about 1/3 of their revenues in partner profits. 3 times 1/3, of course, is 1. So if you took 3 times partner comp, you should end up at about 1 times revenues. That's how we ended up at that place. Now, again, we're seeing those trends come down. And firms that were at 3 times 10 years ago oftentimes are somewhere between 2 and 2.5 times now. Also, one of the issues we run into is firms that have a high level of profitability maybe when they adopted their 3 times multiple, their firm was running at about 33% profits, but now they're at 40 or 45%, and all of a sudden 3 times becomes a significant amount of liability, and effectively almost as much as 1.5 times revenue. So that's another issue we're running into sometimes. So to give you an example of how this all fits together, let's assume that we've got a $3 million firm. We've decided that the multiple should be about 85% of revenues, and so the total intangible value of the firm would be $2.55 million. Let's assume again the accrual basis book value is about $600,000. So the overall value of the firm's $3,150,000. I own 30% of that. Therefore, my value should be $945,000. What we need to figure out, and we'll get into this later in the presentation, is how am I going to receive the $945,000? But that's in essence the total value allocated to me using that method. Another example using the compensation multiplier would be, let's assume I'm making $300,000, and a common technique for determining that might be the highest 3 years in the past 5 of my compensation would determine what my average compensation is. If I'm using a 2.5 times multiplier, that's $750,000. Again, if the overall firm's book value is $600,000, my equity stake is 30%. That might be $180,000. Typically, this is actually going to be in a partner form of entity. You might have actually your capital account is what we'd be talking about. And in this case, the overall value that I'm going to receive upon leaving the firm is $930,000, which is the $750 plus the $180. With that, Nikki, I'd like to turn it back to you for our next polling question.
Okay, here's our second polling question on your screen now. I believe our approach to valuing our owner's interest in the firm is, your options are fair and affordable, fair but I'm not sure we can afford the buyouts, not fair too rich, not fair too low, or not applicable, we don't have an agreement. To take just a moment to select the answer that applies to you. Give everyone just a few more seconds. And again, just a reminder that you do have to answer all the polls in order to get the CP credit today. Okay, let's go ahead and close the poll. Terry, it looks like 46% of respondents indicated that they don't have an agreement, so NA. 28% think theirs is fair and affordable, 23% fair but not sure we can afford it, and the remaining 3% say not fair, too rich.
Okay. And this is, again, common with the firms that we work with. I think oftentimes, we have a situation where everybody feels like, based on what they know about what other firms are doing, maybe our agreement is reasonably priced. Let's say we've all decided, well, most firms our size are at 1x on the revenue multiplier, so we should be at 1x. But what they don't know is how to pay that 1x out. And so oftentimes, maybe the payouts is over 3 or 4 years, or maybe all the tangible equity has to be paid on the day of retirement. And everybody looks at that and says, how in the heck are we going to afford that? And we're going to get into this issue of how to address that in just a minute. But oftentimes, that's the problem, is the terms that back it up. Maybe the tax treatment of the payments is wrong. There could be a number of things that cause what might appear to be the right valuation to not work because the terms are wrong. It's a common problem. So when you look at what's right and what's fair in your firm, these external benchmarks and these surveys are a good place to start. One of the problems is they're incomplete. They don't give you all the information you need. For instance, the Rosenberg survey doesn't tell you what the average firm, how many years they use to pay out the average firm, or on average pay out the partners. They don't tell you what the tax treatment is of those payments. They don't tell you that if there's any difference between how you pay the tangible equity, the capital account versus the intangible. So these are a good place to start for part of the answer, and I recommend that all of those should be referred to. But all they do is give you a guide. Are we in line with the rest of the profession? As an example, if your agreement says we're going to pay 1.5 times revenues, you're not in line. It doesn't mean it's wrong. It may still work for you, but you're way out of line with what the norms are in the profession. The real issue is the internal economics and how you address that, and really are the terms of the agreement, is the overall valuation going to be affordable based on the cash flow impact on the firm. So let's get into that. You know, generally, the basic financial terms that we need to consider are, first, how long are we going to make the payments? It's not unusual to have the intangible equity portion, or what might be called the retirement payments, to be paid on a different time frame than the tangible equity or capital account. Right now, from what we're seeing, most agreements would pay the intangible equity over anywhere from 8 to 15 years. 10 years is still the most common that's used for the payout of intangible equity. We're seeing a move towards longer payout periods. Part of that is to try to accommodate different tax treatment. Part of it is obviously to lessen the cash flow, annual cash flow impact. The tangible equity can run anywhere from all of what's payable at the date of retirement to it's going to be paid at the same rate of as the intangible portion. The norms are, again, that if you're going to pay it less, usually 5 years would be what I would say is average, but anywhere from 5 to 10 years for the tangible portion. Again, the most common way of dealing with the tax treatment is to treat the payments as deductible as paid. If you're in an LLC or a partnership, generally we're talking about guaranteed payments treated as retirement, which would make them deductible to the corporate or to the partnership as paid, and there are some techniques you can use to keep those payments from being subject to self-employment taxes for the recipient. If you're in a corporation, generally we're talking about making the payments in the form of deferred compensation so that it's reported on a W-2, and that makes it, of course, ordinary income to the recipient. It also makes it subject to Social Security taxes, although there are, again, some techniques for minimizing the impact of Social Security and FICA, or FICA and Medicare. But we are starting to see some firms take a more aggressive move, trying to get more of the payments treated as capital gain for the recipient. Generally, if you can make the payments over 15 years and you can amortize them over 15 years, it's no different than paying them as ordinary income. And the recipient then, of course, can use capital gain. Now, this is more difficult to do in a corporation because the only way you can do that with a corporation and make the payments deductible for the corporation through amortization is if you can treat it as personal goodwill, which is a very difficult hurdle for most firms to overcome. In a partnership or LLC, you can actually, it's a lot easier because you can generally purchase the partnership interest and amortize the payments over 15 years. And if you have any specific questions about how all that works, I'd be happy to answer those in an email or a phone call. Another thing that a lot of firms aren't aware of is that most of the time interest is not paid on the deferred payments. If there is interest assessed on any of the deferred payments, it might be only on the capital account. And I'm not saying there aren't agreements out there that have that feature. Many of them do. But keep in mind that if you were paying a 6% interest rate on a 10-year payment stream, you've effectively increased the payments by 33%. So if you're comparing that type of agreement with a 1x multiplier to a firm that has a 1x multiplier without interest, you're effectively saying we're at 1.3, 3-time multiplier. And it can make the terms very difficult to afford. So when you look at how your firm's terms fit and how they'll work for your partners, we use a technique called the backwards valuation. And what that says is that we should pay your partners fairly for all the years of sweat equity they've built up. For a partner that's leaving, they should feel like they've gotten a fair payout, but at the same time, we shouldn't be asking the remaining partners to take a step back in compensation or to go out and borrow a bunch of money in order to make these payments. That tends to demotivate them to do it. It actually can cause them to say, that's not for me, I'm leaving. So how do you do that? How do you make this evaluation? Well, when you look at what's the capital that's available to buy out a retired partner, that capital is basically the compensation that they used to make. And we're going to use that capital for 3 things. One is obviously, to make the payments. The second is we have to replace that partner's labor. Somebody's got to do the work that that partner was doing before. If you've got enough excess capacity that you don't have to replace the labor, you're probably not a very profitable firm. So if you're running at your peak profitability, then you're going to need to hire somebody to replace that partner. And then finally, we ought to have some upside left over for everybody else that's remaining in order to motivate them to do this and to take on the risk and take on the additional work that it requires. So here's an example. We have a retiring partner who generates about 1,200 billable hours at a $250 billing rate, which is $300,000 in production. Based on the norms on the street, you could probably hire somebody, or maybe more than one person, to produce $300,000 in your firm for about $120,000. Now, we're not talking about a partner-level person here. We're just talking about somebody that can replace those same billable dollars so that you don't basically reduce your productive capacity. So if the partner that's retiring was making $300,000 in compensation and benefits, all in, then the replacement resources that we just calculated were $120,000. We have $180,000 left, and we have to decide how much of that we're going to use to pay the partner off and how much we're going to try to leave behind. So in an example, we might have a firm with about $1.9 million in revenues, and this partner owns 45%. If we were using a one times multiplier, that's an $855,000 intangible value. That partner's comp in this example is $275,000. Their capital account's $175,000. So our total obligation is the $855 plus the $175, which is $1,030,000. In this example, the terms call for us to pay the partner off, pay his capital account in the first year, by the end of the first year, which is $175,000, and to pay the retirement payments over 5 years, which is $171,000 a year. And we calculated that in this case, the cost of the replacement resources were $125,000. So how does this work? Well, the first year, remember we've got $275,000 to work with, less than $125,000 in replacement resources. That leaves us $150,000. We've got to pay $175,000 on the capital account, and we've got to pay $171,000 in retirement. So the firm's going to be $146,000 in the hole the first year. And there's only two places that can come from. Either all the rest of the partners are going to make $146,000 in total less, or we're going to borrow that money. In years 2 through 5, to get all the way through the buyout, we're $21,000 per year negative. Needless to say, this is probably not a motivating type plan. It's one that could cause some problems, and everybody might look at that and say, gee, I'm not sure that one times multiplier is wrong, but I know we can't afford this buyout. So in order to fix this, we might instead stretch the payments on the capital over 5 years and stretch the retirement payments over 10 years. Let's go back through the same calculation. So we still have the same $150,000 to work with. Now we're going to pay $35,000 a year on the capital account, and we're going to pay $85,500 on retirement. So in the first 5 years, we have almost $30,000 of positive cash flow, and in the years 6 through 10, we have about $65,000 in positive cash flow. So we haven't reduced the valuation, the overall valuation. All we've done is change the terms in order to make the positive cash flow in order to make it affordable. Some of the other issues to take into account in your owner agreement are caps on total retirement payments. What we're talking about here is how many partners, how much can we pay out in total partner retirement payouts and make this still affordable for the firm as a whole. Typically, we're talking about a percentage of revenues. The range that we normally see is between 6 and 10% of revenues. And what we're saying is if total retirement payments to all partners exceeds that threshold, let's say it's 8%, then the excess would normally be deferred until we no longer exceed the threshold. So we're not asking those partners to forego those payments. What we're asking them to do is delay the receipt of those payments to make sure that we're not bankrupting the firm through retirement payments. Restrictive covenants. There's two different kinds of restrictive covenants that you should be considering using. One is a professional non-compete and the other is a client-specific non-compete. A professional non-compete says that you can't operate as a CPA, assuming you are a CPA, or you can't operate in a competitive, any kind of competitive fashion in a certain market for a certain period of time. The broader you define those, the longer the time, the broader the geographic market, the harder it is to enforce. Typically, if we're going to have one of these covenants in, and I do recommend they normally be included for retired partners, we would recommend that they be somewhere around 2 or 3 years and they be limited to maybe 50 to 100 miles from the offices where that partner operated from. The client-specific non-compete says, we're not going to stop you from being a CPA, but you can't provide those kinds of services to any of the firm's clients. And normally that would be tied to the payout period for the retirement payments. So if we've got a 10-year payout period, the client-specific non-compete might last 10 years. That typically would be enforceable. Of course, it depends on the state you're in, and it depends on what your lawyer thinks about that as well. But what we're trying to avoid here is making retirement payments to a partner that in essence is based on a client list and trying to avoid that partner basically stealing those clients back while we're still owing them money. And I have seen those situations happen. The notice period required, think about this. In most firms, if you had one of your partners walk in and say, I'm leaving tomorrow, I want to get paid out, you'd have a real problem with maintaining the value of the firm associated with that partner's responsibilities. You haven't had time to transition their duties to someone else in order to maintain that value. You're likely to lose clients, you may lose staff, there's a number of things that can happen. So what you need to have is make sure you have a long enough notice period, or else there's consequences to the valuation for that partner. We normally recommend that notice period be 2 years, because that's about how long it takes to properly transition the average partner's responsibilities. Unfortunately, I've seen agreements with notice periods as little as 30 days, which isn't nearly long enough. Another one is I've seen 90 days all the time. And typically those come about because of what a lawyer might suggest from a legal perspective is appropriate, but it doesn't really reflect the business issues that are associated with the transition of a partner's duties. Mandatory retirement age, we're seeing this used more and more often. We're also seeing a lot of pressure put on firms that have them. I have to tell you, I'm a proponent of mandatory retirement ages. To me, if you don't have one, you're basically flying blind. It's difficult for most firms to understand what kind of resources they're going to need to replace retiring partners and when they're going to be needed if they don't know when those partners might leave. So if we're just waiting for someone to walk in the door and say, even if we have a 2-year notice period, I'm out of here in 2 years, we may not have the resources in place that we need to replace the partners. So if we know that that's likely to happen at age 65 or 67 or whatever the age is, we have a long enough period of time to start thinking about managing partner retirements. We are seeing retirement ages, mandatory retirement ages increase. I think it's very rare nowadays to see them as little as 62 or 60, although those used to be pretty common 20 years ago. And there are still some firms that have those type of age limits. More often now we're seeing 65 to 70. I personally think the range of 65 to 67 is best. And then there are special situations that oftentimes need to be addressed, which would include a high concentration of fees in one client or maybe a couple clients, where we have a specific type of risk associated with whether or not that client will stay when someone leaves, or a specialization that a partner might have. I worked with a firm recently that was a 5-partner firm. One of the partners did a type of IT work that no one else in the firm knew how to do. He was managing about $800,000 worth of business. If he had left, we had no way to replace him, and so we couldn't really pretend that that $800,000 represented a value to the firm under the normal circumstances when we weren't in a position to retain that business once he left. So we had to create some specific terms for him in the buyout. With that, Nikki, I'm going to turn it back over for our final polling question.
Okay, the third and final polling question is up on the screen now. Does your firm have adequate talent on the bench to replace retiring partners? This time your options are yes, and we're confident our approach works. I think so, but we don't know how to admit them. No, we don't have the talent that we need, or we don't plan to pursue internal succession. So we'll give everyone some time to answer this final polling question. And just one last reminder that all three are required in order to get your CPE credit. Okay, looks like nearly everyone has voted, so we'll go ahead and close the poll. Okay, this one is more evenly split. We see 36% indicate no, we don't have the talent we need, followed by 28% saying I think so, but we don't know how to admit them, and then 18% each for the other options, the yes and we're confident, or we don't plan to pursue internal.
Okay. Well, for those of you that want to know how to do it, let's talk about that. That's the next section. You know, I think that there's a tendency to think that the way you do this is no different than if you were selling your firm to another firm. So we might say, okay, the value of the firm as a whole, go back to what we've talked about before, is whatever it is for the intangible and intangible value. We'll decide, okay, if we're going to sell this new partner a 10% interest or whatever interest we're going to sell them, let's just multiply that times the total value, and we're going to be good guys and let them pay it over 5 years. We'll probably just adjust their compensation. And that's been done. It may have been how you bought into your firm. It's been done many, many times that way, and I'm not saying it doesn't work. It oftentimes will work. I think that there is, though, a lot of feeling within many of young people that that doesn't work. And I know that we've run into many situations where firms have failed at the point in time when they've developed this person. They've been with them for a long period of time. It's now time to bring them in. We start talking about the specific terms of the deal, and they're like, not what I expected, and they elect out and end up going somewhere else. So in that example that I just said, we've got a $3 million firm, got a valuation multiple of 100%, total capital of $600,000, $3.6 million total value. We might say, okay, that's $360,000. Your 10% interest, we're going to adjust your comp by $72,000 per year. But here's some of the problems you might run into. First is the cost, $72,000 per year. I mean, we're probably talking about somebody who prior to being admitted to a partner might have had a comp of anywhere from $125,000 to $175,000. So $72,000 is obviously a huge number for them. Of course, we're going to have to increase their compensation in order for them to afford it. We certainly couldn't expect them to take a big step back in compensation. But how much do we allocate to them in order to do that? And are we really accomplishing anything if we just give them another $72,000 of compensation so they can pay the $72,000? What have we really accomplished? And if you look at it and you say, well, this is what that 10% interest really ought to be worth in my firm, you know, the amount of compensation that ought to go with that may not be what makes sense to the partners who sold that interest. They might say, I'm only getting this for that. And on the other hand, the person making the investment might say, I'm only getting this for that. So it's difficult to find that happy medium. How do you deal with when it's time for them to acquire more equity? You know, one day you wake up and we've got, one guy that owns 60% and everybody else, 5 other people are splitting up the other 40% because they all came in later than he did, which can cause problems. And then, of course, when you do sell them more equity, how do you value it then? They may have had a big role in building up the equity that the firm now has. So that when they bought in, it was a $2 million firm. It's now a $4 million firm. Can we really fairly say, well, now you need to buy your portion of the $4 million when, in fact, they had a lot to do with building the firm up? Go back to these benchmarking reports. I think these are kind of revealing. The IPA, which is Inside Public Accounting, is one of the benchmarking reports I recommend. And in that report, firms that were less than $3 million had the average partner buy-in was $112,000 for new partners. 3 to 10 million was less than $90,000. 10 to 30 about $104,000. So you can see that there's sort of a feeling that this is about the right amount of skin that we ask a new partner to invest to get in the game. The Rosenberg survey gives us a little higher numbers. I can't explain why they're different, but they're roughly in the $130,000 to $160,000 range for new partner buy-ins. Now, it doesn't tell us what they're buying in. It doesn't tell us the amount of equity that they're acquiring. It doesn't tell us how they were valued, but it just gives you an indication of sort of what is the right amount of skin for someone to have in the game when they buy in. Let me give you a couple of alternative approaches to how to do this. One is what I call a unit system. Many firms refer to this as AAV, which stands for average accumulated value. And in a unit system, we'll get into the specifics of it, but in essence what we're doing is we're saying, let's go back to the concept of what makes up your value. You've got your tangible value and your intangible value. We're saying we're going to create a separate stream or a separate ownership stake in the intangible value than we are from the tangible value. So I might own 20% of the tangible value, but own a different percentage of the intangible value. And we do that through this unit system. And then the other technique is to use a long-term vesting program for new partners. So we don't worry so much about how much equity they're actually accumulating or being allocated in the beginning because they really don't have any access to it until they've been with the firm for a long time. And oftentimes that long time might exceed the amount of time that's required for the senior partners to, leave and start receiving payments for their retirement, which is really what one of the aims of bringing new partners in might be. So in the unit system, we're oftentimes setting up the intangible values expressed in units tied to the firm's volume. So if we have a $2 million firm, we might say we have 2 million units. New partners are not required to buy any units up front. Sometimes they're going to be awarded some units because of some recognition that they've helped build the firm, and I've oftentimes seen they might be allocated anywhere from 25,000 to 100,000 units, and it might be tied to part of the new business they might have brought in over the recent years. They're going to earn their allocation of units both through participating in the firm's growth. As the firm grows from 2 million to 2.5 million, they are allocated part of that additional growth. And they're primarily going to earn their unit allocations by buying out retired partners. So as we buy a partner out that has 1 million units, and let's say we're doing it over 10 years, 100,000 units per year, then they're going to be allocated a portion of that 100,000 units each year that those payments are made. In this case, this allows us to limit the upfront investment to the tangible value only. So if our $2 million firm has a $500,000 tangible value and we want to sell them a 10% interest, it's going to cost them $50,000, and we can still spread that over several years. So here's an example. We might have a firm with $3 million. That's 3 million units. We might allocate those units between these three partners based on some reason that we had. It might have been based on if we were going from one type of agreement to another, what their relative values were at the time we made the transition. So we allocate it that way. The new partner comes in with no units. And then the next year, or maybe the next 2 years, we've grown from 3 million to 3.5 million, created 500,000 new units. In this example, those new units were just allocated equally. It doesn't have to be that way. It can be based on some other basis. It can be based on some other performance evaluation or some other formula. And in this case, we might agree that the firm's value is going to be 90 cents per unit, which is effectively a 90% valuation. So 90 cents times 3.5 million represents the overall intangible value of the firm. In a vesting program, what we're talking about is how we vest a partner's rights to the payout of intangible value. It works especially well with compensation-based systems. Excuse me. In a compensation-based system, let's say we have 3 times compensation as our valuation technique. If a partner is making, even if they're a brand new partner, they're making $150,000 a year, they now have $450,000 of value. And that happens on day one. So how do we, they haven't necessarily earned any of that. They haven't necessarily bought it and should be able to collect any of that. So we control that through vesting. This allows the accumulation of value for the new partners to be delayed until the senior partners are retired. In essence, the value is earned through tenure with the firm. It promotes retention of success for the succession team and allows for a lot more flexibility on your initial buy-in because you don't have to worry about giving away accumulated value. So in this, as an example, a new partner comes in, we might sell them 10% interest in $500,000 of tangible value for $50,000. And if they've paid for that, they're fully vested in it. But then their intangible value might only be available to them, say 50% cliff vesting after 10 years with an additional 5% per year for the next 10 years so that they become fully vested after 20 years. We can also add on to that an age vesting if we want. For instance, we might say you're 50% vested at age 55 and you're fully vested at age 65. And so your overall vesting is based on the lesser of your tenure vesting and your age vesting. That's another technique that we often use. So with that, are there any questions, Nikki, that we've received that I can answer? Or?
No, actually, Terry, we didn't have any questions. We'll give everyone just a moment in case one comes in.
I must have been very clear in the way I explained everything.
That's right. Yes, exactly.
So with that, again, I would like to invite you, if you have any questions or any additional comments or suggestions or anything you'd like to talk about, I'm open to taking phone calls and also email inquiries, and appreciate you attending today.
Great. We did have a couple questions come in just now, Terry. One of them is, does comp include all benefits?
That depends on the firm. I would say that I've seen it done every different way you can imagine. It also probably depends on the type of entity you have. If you're a corporation, I would say there's a tendency more to use your W-2 comp as the compensation. If you're a partnership, I think there's more of a tendency to use comp before any benefits because those tend to be treated differently on your K-1. So it's not necessarily a right or wrong answer, but needless to say, your agreement needs to clearly define how it's done, and you need to be consistent. So,
okay.
What's the other question?
Let's see here. How do you avoid SE tax?
Okay. There is if you'll send me that inquiry again, and in fact, we're going to follow this up, and Nikki, remind me. I'll put the code sections in our follow-up email. There's some specific code sections, and they actually pertain not to the corporation, to the firm, but to the recipient. How the recipient avoids SE tax. But there's generally 3 different hurdles that you have to get over. They are not difficult to get over, but they do logistically require you got to jump through some hoops. One of the things you have to do is you can't be receiving compensation for ongoing services. You have to have your capital account paid out first before you make any retirement payments. And you have to be receiving your retirement payments over your lifetime, which sounds more onerous than it is because most firms that bother to actually, I'll tell you, a lot of firms don't bother to meet these rules, but the ones that do will usually pay $100 a month for life after the base payments have been made. So if you're making your retirement payments over 10 years, and that could be a lot of money, it could be $100,000, $200,000 a year for 10 years, at the end of that period of time, they continue to receive ongoing payments of, say, a nominal amount, say $100 a year for the rest of their life, and that is generally considered to meet those requirements. But we'll include the code section sites that you can go in and look at the code section yourself. That's how you avoid the SE tax.
Okay, another question. What security is provided to the seller?
This is a big issue. I've seen agreements where all the partners are required to personally guarantee the payments to the seller. I can tell you that I've seen a lot of new partners say, I'm not doing that, or other partners say, I'm not going to continue to do that. The majority of firms that I work with do not have that any kind of personal guarantees as security. You know, I guess you've got to be comfortable that your partners are going to follow through. But, you know, there's things you can do that will keep the firm from avoiding making payments through, you know, legal maneuvers such as merging the firm or selling the firm or liquidating the firm. There's certainly those kind of safety net you can put in. But as far as personal guarantees, you know, it can be done, but it's rare, and it can cause problems with respect to new partners. Let's say, for instance, that you've got 3 partners that were there when a partner left, and they personally guaranteed it. They bring in 2 more partners. Should they be personally guaranteeing it, and how can you justify that when they weren't there when the first partner left? So it's it can be tricky when you get into personal guarantees.
And that's actually our last question was, I think, sort of similar. It says, how common is it for remaining partners to guarantee the retiring partner's buyout?
Again, I would say it's uncommon. Maybe 1 out of 20 agreements I see have that feature.
Okay, well, that's all of our questions.
When it happens, it tends to be much smaller firms. It's usually a firm that has, you know, 4 or fewer partners.
Okay, great. Thanks, Terry. Just a reminder, there's an email that you'll receive from me later today. That'll have a link to some of the articles on our website that Terry feels will give you additional information relevant to today's webinar. Then you'll get a follow-up email from Terry once the webinar recording is on our site. And in addition to the link to the recording, you'll receive some additional information such as the answer to the question that Terry referenced earlier. We'll go ahead and end the webinar now. Just remember to, before you close your browser, do fill out the brief survey that pops up after the session ends. That is the other requirement that you need to meet in order to receive your CPE credit. And once that has been met, within 10 business days, I will email your certificate. If you have any questions, feel free to reply to the email to reach me, or you see Terry's contact information there on the screen. Thanks, everyone, for attending.